Hello, everybody. Welcome back to another episode of Not Financial Advice. I'm sorry my audio is not amazing today. It's okay because I'm not going to be doing that much talking anyway since we have Sean. So the mic's not working for some reason. But in the context of Chairman Powell, the economy is working. We should be crashing the way we are crashing, and it should be going the way it should be going. So we're going to start off with this, Sean. I want to get your general thoughts on the macro, but I think the way to introduce this is with this story. Kathy Wood today wrote an open letter to the Fed. This is the first time I've ever seen a manager kind of write a letter to the Fed. I know Bill Ackman does it through Twitter, stuff like that. But this is a very direct letter that she thinks Jerome Powell thinks that he is Paul Volcker and that he is unequivocally not Paul Volcker and that he should not be doing what he's doing. What are your thoughts right now about what she thinks about deflation coming up and if the Fed should be raising rates the way they are?
Man, there's so much to unpack in this one statement. I mean, that's part of the issue here. So first of all, it's funny you mentioned Ackman, right? When I think about Ackman and the reason he does these things, he's an activist investor. It's his job to create attention, create buzz, good or bad, but bring attention. I wonder if Kathy's not really trying to do the same here because, let's be honest, her results have not been great. She is now charging higher and higher fees for new offerings. This isn't, I'm going to answer your question, but I just want to call it out that I don't know how much of this is grandstanding, and Kathy just realizes she needs to start to look good in the public eye again because no one cares. No one wants to hear, and no one's interested to hear her thoughts if she can't run her own funds properly. Maybe she shouldn't be commenting on how to run the country properly either, right? I do think, though, the bigger issue at hand here is it is very difficult for a lot of folks who have not been through recessions before to understand the scope and the pain of what a recession feels like. For years and years and years, people will say, you got to be ready for it. You got to do the right things. This is why you hedge your positions. Assuming you're doing a lot of trading or holding a lot of big positions, the name of the game is protect yourself because it's going to be bad. And of course, what do people say? Yeah. I know. It's fine. I'm investing for the long term. Then the minute these things happen, it's panic. I'm selling everything. I'm out. Why does it go down every day? I don't understand. I hear this every day. Like this is insane. How could it possibly go down? It's like this is what happens. Now, as it applies to the reasons why, forget about the letter, whether it's meaningful or not, right? Because for me, I could care less what she wrote in the letter, frankly. I think the reality is that we have to take a gigantic step back and understand that the Fed's job is to control inflation, okay? Like if we brass tacks this, get down to the first principles of what they exist to do, that's what they exist to do. They have inflation goals, and they only have only a couple of levers or knobs they can pull or turn. So the issue at hand here is Powell is in a box. It's a shrinking box with less and less options. And for folks who have been around for a longer time, I would include myself in that, who have seen the consequences of using those levers and buttons and knobs too early, is you end up with only one direction to go, and that's quickly and aggressively increasing rates. Now, this is sort of a unique situation because even when I see it myself, I almost can't believe the way things are going and the fact that we're just going to like purposefully pummel our economy. But we have to remember there's Jerome Powell rather, and then there's the Fed. The Fed is an institution. It's not a person. It has a goal and a purpose for existing. The person who's in charge of it can implement it the way they see fit, but at the end of the day, it's an institution with a job to do. And I think that what's happening here is we have only two routes we can go. We have to keep raising rates and keep making things worse, or we have to stop and admit that we can't control inflation. And I don't think either one is the right one. So the natural reaction for everyone out there is to feel, number one, pain. And for someone like a Kathy, it's going to be, how can I come in and put my voice out there to say, hey, look, you shouldn't do this. Hey, look at me. My fund's doing terrible. It's not my fault. It's because of what the Fed's doing. And be that as it may, at the end of the day, they are trying to get inflation under control. And let's be honest, inflation is not under control. It's out of control. And I think that this is an unpopular opinion. And I also think he hasn't chosen his words as wisely as he has in the past. But we have got to get things to a point where people start to shift the things they're doing. I mean, like cars are still being sold for $1,000 a month payments. House prices have not come down. Now I know people are going to say, yes, they have. No, I understand they've come down. They've not crashed down, right? And we're still looking at a market that isn't that far off its highs. I mean, not really, not truly. Yeah, sure. Some unbelievably high growth stocks that were pieces of crap in the first place are now just the pieces of crap they were without all the hoopla and hype around them.
I was literally gonna say hoopla. You took it out of
Yeah,
my.
I don't know why. I don't know where that came from. I don't think I've ever really said that before, but a lot of hoopla and hype around them. And and I think that this is, if you were a holder of a stock that was worth $100, it's now worth $10 or less. You're sitting there and you're saying to yourself, like, oh my God, this is ridiculous. How can he do this to us? How can he do this to me? Does he understand how hard I work for my money? But the problem is we also can't have $9 gas. We can't have all $1 million homes. We also can't have every car is $80,000. It just doesn't work. And when we see everything rising in the same direction, this is what happens. There's an entire layer of the economic society that exists that's invisible to probably 95% of the people out there, because they've never taken the time to understand the interactions and the interconnectivity between what the Fed does, inflation, pricing, assets, income, etc. And there's this really tough but true thing that exists. We can't just keep raising pay. We can't just keep letting assets increase in price. We can't just keep letting the economy explode in one direction. And I think that's why what's happening feels so wrong, because it feels like, well, wait a minute, what he's doing is he's stripping our economy of its strength and its power. And it's true, that is what he's doing. But until the interest rates reach a point, I mean, I don't remember what they are off the top of my head, but like look at like near-term bond rates. People who have never touched a bond in their life are like, whoa, 7%. I'm getting into bonds.
Yep.
This is what's supposed to happen, right? People are saying to themselves, like, well, instead of going out and buying a new car, maybe I should take that money and throw it in and make 7% on it. Right. And then, of course, the other part of the crowd is saying, like, 7%. Yeah, but inflation's 15. It's like, exactly. That's the whole point of why this has to keep moving. It has to reach a point where equilibrium happens, and then we can either stabilize or drop the rates. Traditionally, people can interpret this however they want. Maybe they see it a different way than I do, and that's all good. But traditionally, we never saw rates get down to 0, 1, 2%, crazy numbers like that. And the reason is because you need to have the ability to flex the interest rate based on the credit market, based on the economic asset market, right? As certain things go up, other things have to go down, and vice versa. We hit a point where like we floored everything. They couldn't go lower, basically. And everyone loved it because everything was worth so much. But it's all relative at the end of the day. I think I think now is a great opportunity for those who have never been through a recession, or you've never really been through a tough market before, to take a step back, excuse me, and really understand that there's a bit of a beauty in the way these things work, in that everything comes down to some degree, just like everything went up to some degree. So the last thing I ever want is for anyone to lose their jobs or see less money coming in or see their asset prices come down. But the reality is there has to be equilibrium met here. Water has to find its level in the case of our economy. And as much as it feels like we all can point the finger and blame one person, and it's easy to do this, it isn't all just that, right? There are a lot of things happening. I think what makes this situation feel so bad, we literally are seeing things trending like nuclear war. You know how insane that is? You know how insane that is?
Wild.
Wild. I mean, I can't, like, on the one hand, I'm reading articles about how we sent a satellite to hit a comet just to see if we can protect the Earth someday. And then what are we doing back on Earth? We're worried about a possible nuclear strike on one country from another. It's
a good point.
It's the saddest thing in the world, frankly. It really is. And now you take all of that, these really terrible events, and you combine it with the fact that we've got this economic stuff going on, right? And maybe you throw in that it's hurricane season, and you throw in that interest rates and home prices are still really high and people can't get into homes. Like this is a period that happens all the time where there's an extreme amount of pain, and the pain is right in the middle. But I think for people who are likely to watch this podcast, I think the takeaway that you want to have here is you cannot misunderstand the opportunity at play. You can't both talk about how, wow, things are so expensive, I can't buy a house. I don't have enough for a down payment. The interest rates are so high. Yeah. As the interest rates go up, right, which happens very quickly because all it takes is like, yo, Powell, rate going up 75. Okay, done, right? That's it. That's how fast the rates go up. Home prices take time to come down and become affordable because it's not a robot. It's not AI. It's not machine learning managing home prices. Real people have to accept reality and say, man, you know what? 3 months ago, I could get 800K for my house. Why can't I get 800K today? It takes time for them to accept the reality that, like, all right, I guess 650 is what I'm going to have to price this at, right? And this is going to happen through all the different tiers of pricing within the market. I'll tell you a story in a second about some stuff going on that I have in the real estate space that I think is going to be a bit more interesting and also a bit more front loaded from a price perspective because people are more aware of risk when they have more and larger assets in the market. And this is sort of the world I'm in and I pay attention to. So I had looked at an office building probably about 6 months ago, insanely overpriced. One of my partners on an LLC that I have, he's also a broker. He brought it to me and was like, hey, I know you've been looking for something like this. Prices were no good. Building's extremely ugly, terrible paint job. It's a beautiful brick building, but the inside is terrible. It needs to be repositioned and then eventually recapitalized when the time is right. So he tonight, before we actually set up this episode, he had just pinged me or emailed me rather, and was like, check out the price. I mean, this thing is half basically of what it was, right? And he said I could realistically probably make a really aggressive offer and get even more off the price. Excuse me. And the reason is because folks who are in the commercial real estate realm, they're looking at, excuse me, they're looking at data in a different way than someone who's trying to buy their first or second home. They're looking at the data from the perspective of like, can I fill these offices? How much will I be able to charge? What does that do to the cap rate of the building I'm trying to sell when I want to sell it? Am I going to break even with new interest rates? Do I have to roll over my loans, especially if it's what's called a DSCR loan? You can't prepay those. So you're stuck in the rate no matter what, but you also have to completely pay that off with a balloon at the end. So when you look at the sort of realm around commercial real estate, you need to be aware of a lot of different pieces that are coming in at any given time because there's also a finish line. It's not enough to say like, hey, as long as we get rents back up in 3 years, I'll be okay. It's like you might have to get a new mortgage in 2 years. And if your rates don't cover that, then what are you going to do with your building? And then similarly, for folks who say there's nothing that they can afford, there's no way they can find a place to live, everything's insanely priced. I had a call the other day about a 2-family in the Midwest. Now, I know everyone's going to say Midwest pricing is different, but I just want to call this out for the sake of calling it out. Not a terrible area, like a B grade area. It's a 2-family. They just dropped the price from 150 to 130 to 120 to 100 to 80 to now 70. My guy was telling me I could pick this thing up for 60, no problem. It's rehabbed. Wow. Each unit does 850, right? So call it 1,700 a month. So it's a little over 20 grand a year on a 60K purchase. That means even if I paid cash for that, that's like a 33% return on my cash. And the reason I'm calling out both the aspect of the small, low price 2-family is because those markets are waking up and realizing, hey, look, I don't want to get stuck in something that I can't actually really afford. So they're letting the big players come in and buy this stuff. The commercial markets are doing similar things where cap rates had been compressing down to 5% and 4% cap rates. Now they're coming back up 7, 8, 9, 10. Market dependent for anyone who's a big real estate bigwig, I get it. But, market dependent. And you have to start thinking about how they're seeing what's happening at the Fed. They're drawing out a long-term conclusion. They're looking at the data points that are coming in from all these different areas, and they're getting ahead of it. 2 cities over from me, someone just listed, I actually can't even believe it. I wish I was in the market for this, but I'm not, a 80-unit complex for sale. This is a place that I'm telling you, a year ago, I would have said they're never selling this. This is so well placed. It's a high-end community, 97% vacancy, right? Or 3% vacancy rather. Great property, looks beautiful, maybe needs a little updating, whatever. They're looking for a price that's way too low. And those are the things I'm paying attention to in parallel to what's happening with Powell, in parallel to what's happening about jobs data, in parallel to CPI data. And the picture is bleak. but it's only bleak if you look at it from the standpoint of how does it affect you. If you look on the other side of the Hertz coin, it's the opportunity coin. And the opportunity coin is the one that says, look, don't wait to lose your job to start saving your money. Don't wait to find something new or a side hustle or a way to, scrimp and save a little extra until something bad happens. If you've been waiting to get in the real estate market and you've been sitting on cash on the sidelines, maybe it's time to start thinking about where you want to go and how you're going to deploy it. I think what Powell's really doing is my allergies are terrible tonight, Amit, so sorry about the coughing here. I think what you have to start to do as an investor, as a trader, as someone who's interested in the macro world, is just, you have to separate the pain of what's happening as just another KPI or metric or something that you're tracking as part of a larger thesis on the marketplace.
Well, let me ask you a question here.
Yeah, please.
March 2009, when we had a recession, that was the best time to buy. It was the bottom. You said, you have to worry about saving your money and you have to worry about, side hustles, all this stuff. But then there's also this big dip, which might make you really rich in the next 5 years. How do you couple buying the dip and going all in on this opportunity versus actually saving your money and getting through your own life?
This is why not everyone's rich, right? I think that's an unfortunate but true statement. And I heard a great quote earlier today, and I want to get to your question. Someone had made a comment like, wow, if I could go back in time and start buying all the real estate in 2010, I'd be all set.
Yeah.
And the comment was, but you wouldn't have done that because the world was falling apart. Why would you put all your money into these assets that you had no idea when the bottom would come in?
Yep.
In hindsight, it's easy to make the statement that 2009 and 2010 was the time to buy. There's a reason. There's a reason why people didn't. They were scared. I think that if we separate this out into people who are, if you're in a position where you can potentially stay at home, save some money, not have to worry about having an apartment or a family, or even if you do have those things too, finding ways to pull out a little bit extra or find ways to make a little bit extra in the interim. I think that this is a time to think about how and where you can deploy that capital, whether it's just adding to shares or it's buying your first small property or it's buying an office building because it's 50% off the price that it probably will be in 10 years, right? This is the toughest part about recessions is they hurt people so bad, but they can also accelerate people extremely quickly as well. And I think that we've had enough of these over the past 100 years that it can't keep being a surprise every time it happens. And you can't keep spending every dollar you earn and an extra 50% on credit, knowing that they're going to happen again. So although I feel the pain for the people who are in tough situations, you can't want to be a big time investor, whether that's in investments, in equities, or it's in real estate or in some other asset class. You can't keep wanting to be a big time investor and not look at the global picture of where things are going. I know, just not to make this but what I did, I've been talking for a year about hedging and making sure you have downside protection and identifying areas of risk and how to protect it. And it's just not sexy to talk about that because when everything's going straight up and vertical, people look at that and they think why would I spend $200 to buy a put, protect my biggest position? It's only going to go straight up. And then the minute it crashes, you hear the horror stories of people going bankrupt, losing everything. It was all on margin. And you say well, why didn't you just buy puts, right? They're cheap, they're easy, provides total protection. And they're like, well, I didn't know anything about that. Well, I mean, you went all in on something, but you didn't know anything about it. It's like this cycle just keeps happening over and over again. And the same people keep doing the right things. They keep waiting, they keep acting, they keep getting prepared for it. So I just think that at some point we have to have the ability to look at history and understand what happens and how it happens. And you don't have to time it perfectly, but for crying out loud, what Powell is doing only has one effect. We know what direction it's going to send things. Even if the data is not showing it today, it doesn't matter. Now, I'm sure we'll get into this, but this is also where you have to pick out the diamonds in the rough. I know that you talk about Palantir all the time. I do a little bit, but I want to just call it out. There was some huge news that came out about Palantir as an example that sort of bucks what's happening in the market. So maybe that's an area to start thinking about doing research if you're in it and you want to add, or if you're not in it and you're thinking about it. And conversely, then we see a company like a PayPal making like possibly a cataclysmic decision that's going to hurt them real bad. But all this to say is that starts with understanding what is the trend in the market and how you identify those that are above the trend and going opposite of it somehow, even if that means staying steady or whatever the case might be.
So if you said Powell's, we know what direction it's going to go, given what Powell's doing. Why shouldn't someone sell their whole position then and just wait to buy back in?
I don't know why they wouldn't do that. I absolutely take losses. I write them off. I think it's important to understand, though, that you have to be aware of things like wash sales. You can't sell a position, then buy right back in for equities.
Yeah.
For those with crypto, and by the way, not only not financial advice, not tax or legal advice here. I'm neither a CPA nor an attorney. Crypto is still seen as a currency type asset class. So you can sell it without wash sale. So you can take huge losses, immediately buy back in, write those off, right? At least for now in the US. And I ask this question all the time on Twitter when people talk about like I'm down 90%. And I'm like, no, that's not possible. How could you be down 90%? Why was there nothing there to mitigate being down 90%? And they're like, it's okay, I'm going to DCA. It's like you can't. And by DCAing, what's happening is you're missing out on all of the opportunity to even get a chance to make your money back.
Yeah.
This is more a word of caution and that I want to throw out there because it's really popular on Twitter. The Twitter dividend verse is massive.
Yes.
And people have huge followings.
There's literally people named the dividend.
Tons of them, thousands of them. And don't get me wrong, I love dividends. I have a huge dividend income. I could live on my dividend income. I don't ever talk about that, but I could easily do that. They're taking this opportunity being like, wow, I can get into stock XYZ. And instead of a 3.5% yield, I'm getting a 4% yield. And then of course I'm sitting here and I'm like, oh my God, man, by the rule of 72, that's going to take you 17, 18 years to double your money. Yeah. When there's growth stocks that are down 90% for no reason. There's some bad ones. There's a lot of bad ones, but there's some that are down for really no good reason where you can double your money in maybe 18 months, 24 months. And like people are paying for courses, they're paying for training for people who are earning 4% on their money. I mean, the bonds are earning 7%, right? And then the argument would be like, well, you also get appreciation. And what this speaks to isn't that they're wrong. I'm not criticizing anyone. What I'm saying is, we talk about this on our podcast all the time, man. To be good at this, you have to keep concentrically moving further and further out of your bubble from understanding not just like what a good stock might be, but what a good market is. Is it a US market? Should you go overseas? Should you move into currencies? Should you move into different asset classes? Should you bump up to real estate? Do you know how the Fed works? Like, people will go and buy their personal home and they'll pay to have someone come in and, do a full inspection from top to bottom floor, but they won't spend 15 minutes understanding the difference between a 4% yield and a stock that will double in 18 months. And I think it speaks to the fact that we're looking for easy comfort level. And when Powell does things that make us uncomfortable, the reaction is like, oh God, that's so uncomfortable. What Powell's doing is he is painfully, maybe somewhat mistakenly, trying to reset a market that went completely in one direction for a very long time. It just has to come back. It sucks. I get that. I hate even having to say that, but that is the reality of what's happening here. The market couldn't self-correct because it was only going up. And the banks were never going to stop lending at 0% because they're selling those loans in the secondary market and packaging them up as collateralized debt. I can't even get the word out today, but you know what I'm saying, right? And so the issue is people look at these problems at a very surface level, like, well, my portfolio is down 40% and I hate that. That sucks, right? Or, hey, my portfolio is down 80%. Or like, hey, I was all in on some crap stock, but I thought it was going to double. And now I'm out all my money. Well, it's Powell's fault. Well, for the record, this didn't happen over the course of one weekend. How long has the Fed been raising rates? It's not like this just happened. It is happening. It has been happening, and everyone knows it's going to happen. But yet no one is shifting to do the right things in their portfolio or protect themselves. I just want to call out one more time what you said, because your point about like, why wouldn't you just sell it and keep the dry powder? Well, that's, I mean, if you watch Bloomberg, if you watch CNBC, if you read the Wall Street Journal, and by the way, if you're not doing any of these things, I question how serious an investor is. But if you're not doing these things at a minimum and you invest in equities, that's a problem, because you know what they all are saying? Every hedge fund manager, every asset manager, every major fund is like, yep, I moved to cash. I've got 80% of, not 80, I've got 20% of my portfolio in cash or cash equivalents. And like what they're literally saying is, yeah, I sold out of my positions so that when the market reprices or recaps, I'm ready to go in and find opportunities. But the retail investors will take a 90% loss, say it's market manipulation, and that they got screwed. When literally the people they're accusing of market manipulation are going on live TV saying out loud, I'm selling everything, I'm going to cash. So this theme of personal responsibility, of education, is so important. And
what you just said reminded me of the Eat the Rich documentary on Netflix.
I just watched that the other night. Yep.
I watched it the other night of like the people that are on TV saying sell are then getting blamed for market manipulation by the people who are not taking their advice for doing what they're doing. What were your thoughts on that? I mean, obviously you and me probably intimately followed that GameStop saga. When you saw that documentary, was there any emotions that you felt seeing it all happen again?
Yeah, I wish I got in earlier and stayed in longer. That's what I felt. Yeah, no,
Did you play GameStop? Did you do a trade on it when it was going
up? I did do GameStop and AMC, but like this, I think you know my personality at this point. After I saw some pretty good gains, I was out, moved on to the next thing I wanted to focus on. I wasn't trying to chase that thing all the way. It's just not my style to do that.
There was a guy who put in 500K, and you look at his Robinhood at the end, and it's $5, literally. Do you remember that part? Like,
yeah, that was insane. Well, it's just like, again, I get that people just want to gamble, and that was sort of the theme in the beginning, was like they were just gambling. But even when you go to a casino, don't you want to end up leaving with some money? I think that's the part that I just can't get here, is like, come on. I thought what was really interesting about it was talking when they had the professional investors talking about the fact that, like, look, the reality is this, but everyone else is saying no, that. And as someone who sort of is like, sees both sides, I was just thinking to myself, like, so many retail investors just want to follow a trend because it seems like it can't ever stop. But the most important thing, okay, let's take a big step back. So I used to sit down with some folks I know who wanted to get into investing and trading, and we often would talk about explaining how to look at charts, how to read breaks, how to understand when the collapse was coming on different things. And I would show this whiteboard where I would show like 10 people in the room, right? I want to buy this for $1. Well, now that you like it, I like it for $1.25. I want it for $1.50. I want it for $2, all the way. And we just kept going and going and going and going and going until it hit like 100. And I was like, the minute I'm at 100, and I'm like, okay, I'm out, and no one else has any money left to buy. So the next person in line who can afford to buy it is like, well, I guess the best I can do is 80. So now instead of going up 10 cents at a time, it drops $20. So everyone else who has it is like, holy shit, I'm going to lose all my money. I'm out. I'll take 60. I'll take 60 so I still get $60. Then it's 40, then it's 20, then it's 0. And this is how bubbles burst, whether it's any asset class at all. This is the classic case of a bubble, right? Now, what makes this so difficult is we're talking about like margin, we're talking about like cycles within it. So the algos start to think that things are going up. Then the funds want to jump in to grab their 10% of flesh. And then everyone who's late is now trying to jump in. So it just becomes this like upward spiral of never ending profit until the last person pays the last highest price, because it always will happen. And then it just starts to go down fast. And now some companies can do really well and figure out a way to make that work, and some can't, to each their own. But I think the lesson of that documentary was really like, I mean, they didn't say this in the documentary, but for me, the lesson of the documentary was have an exit plan and set it, right? Whether that's trailing stops or knowing when to take your profit or taking some money off the table even, right? Take your initial investment out maybe. And I know anyone who hears this is going to say, well, it's not diamond hands and blah, blah, blah. It's like, listen, I've held stocks for 20 plus years. I get it. But they're good quality companies that are going to be around for a very long time. It's not the same thing as like, I mean, Amit, to your point, going from what was that, 50,000 to 5 million or whatever, I forget the number.
500,000 to $5.
Yeah. To think about that, that was life changing. When even the gentleman at the end who had the family who ended up doing okay, but still lost most of it. It's like, you know, you had a trajectory to change the entire way your family would live forever, but you had to get another $2.
Yeah.
And that $2 cost you hundreds of thousands of dollars. So I think it's important to understand that like you can be greedy and still put a stop loss or a stop gap behind you to make sure you don't lose everything, right? And if you slide backwards and you get called, you have a ton of profit. And if it keeps going up, jump back in again and set another stop behind it, right? Like there's so many things that make manipulation impossible to happen. But yet what do we hear? It's fixed. It's 100% fixed. And I would challenge this. The same folks who say things are fixed, I would ask them, sure, explain to me the operational back end of a market and tell me how it works. How does clearing work? How does a market maker work? And tell me, I mean, fill me in on the details that you understand about the system you're calling manipulation. Because you
their argument was Ken Griffin talked to Vlad and got the job done. And it's like, okay.
That part is not what I'm talking about because I don't use Robinhood, but I still could buy and sell that no problem. Those were just specifically Robinhood traders. And let me be honest with you, they should be suing Robinhood. I don't know why they didn't. In fact, I was tweeting like crazy, calling him and the company out, fire this guy. He should be let go immediately. This is fraud. But people just, nobody cared.
Yeah.
I know we're way off the topic of the original here, but
do you think in the next bull run NFT and cryptos also just goes this nonsense that it did in 2021, or is the next bull run going to be more tame because at least a generation of retail investors will have felt the pain of 2022 probably until 2024?
That's such a great question.
Like you're a better investor because you went through 2008, and I'm assuming 2008 wasn't the best for you because you weren't as good of an investor as you are now, even though you probably hopped on some opportunities.
Go back further, man. 01.
01.
In 01, I know so many people who were paper millionaires. I was an adult in 01, right? I started trading in oh my gosh, what year? 2000-ish, give or take. 2000, early 2001. So I witnessed it live firsthand, money in the market, right? And let me tell you something. I was investing in mortgage-backed securities because everybody was investing in mortgage-backed securities. Now, through an act of God, I had gotten out of them because they were starting to cut their yields at that time. So I pure luck, no genius, all luck. But I watched it happen in 01. Then I watched it happen in 07 and 08. And in 01, I was too young, too inexperienced to really understand how to properly capitalize on what happened after. Yeah. But I learned. In 07, 08, when I saw the signs, I started preparing. Yeah. I started putting cash away. I started making sure I knew what I wanted to do afterwards. So when the S hit the fan, I'm a natural risk taker, although it probably doesn't sound that way when you hear me talk, which is why I talk about stop losses and puts, because I'm willing to go all out on the asymmetrical win, but I'm not going to lose all my money just to do it. When 08 happened, I was working in the debt space, doing a lot of mezzanine bridge and commercial debt. And you saw it happening. Brokers were suddenly going out of business. They suddenly couldn't offer you rates. They weren't able to give you quotes on lending. And I remember watching it all happen live, what was going to happen, but yada, yada, yada. The beauty of going through it in 01, recognizing the signs in 07, late 07, early 08, was I started selling everything and moving to cash so that when the time was right, I jumped in and started buying real estate. No, I did not time it perfectly, but the reality is in hindsight, it looks pretty perfect, but it's just because it's gone up so much. So although right now we're feeling the pain of how low things are, in the scheme of things, we're not even close to low. Yeah. We're just low in relative comparison to where we were a little while ago. I think that for everyone who's going through this right now, there should be, and the first and biggest lesson a retail investor in the equity space needs to be aware of is this is why you don't use margin if you don't understand the risk and how to protect it. That's number one. I think number two if you are looking to spend big money on things like a house, like a car, like anything that's going to take significant cost, just ask yourself a what if question. What if I lose my job? What's the worst case scenario? What if I can't get hired for 6 months? What if I have to pay a 7% interest rate? And I know it's hard to say that in hindsight. I totally understand that is hard to say in hindsight. But if you can get halfway there and take the lessons you're learning from it, you're going to be very successful. Like, I think if any lesson should be learned here, it's that you can't hear what Powell's saying and not take action on it. Or just don't check your portfolio. That's okay as well, by the way. Like, if you're just throwing your extra money from your paychecks to acquire positions, I think that's you're a genius. You're going to probably be a millionaire. But you can't check your portfolio every 8 minutes, give yourself anxiety, and convince yourself you need to get out of positions. It's very, very different if you're investing in, I'll just throw like some of the popular ones we hear, like QQQ, VTI, VTSAX, whatever, right? Like, if you're in index funds or broad-based funds, DCAing is the name of the game because it's a blended position. If you're in, how I feel about companies like Upstart. If you're in Upstart and this thing is down 95%, you lost 95% of your money. I mean, that sucks, but like, you probably did. It's probably not going to ever get anywhere near that again. So the question then is, what can you do today moving forward, and take that as the cost of education, and I will never let it happen again. And that's okay as well. And by the way, you'll be able to write that off for the next 10 years, right? At $3,000 a year, it's not the end of the world. That's going to help you out at tax time forever. Again, not a CPA, but you should definitely be thinking about that. Too many people.
That psychology of an expensive lesson, I feel like sometimes people are afraid of that, but that's just life, right? Life is an expensive lesson in a lot of different ways.
Life is just an expensive lesson. I agree. Like, when you don't get that promotion at work, and it feels like, let me even, if you spend your day thinking that, like, every time something bad happens in the world, that the world is against you, usually it's not the whole world against you. The whole world's kind of indifferent. It's not the economy against you. It's not Powell personally against you. It's not real estate prices against you. It's not the brokers against you. I mean, if you had a stop loss, or you were protecting your downside on GameStop, and you were using Robinhood, you still would have been fine. That sucks to hear that. I get it. It sucks. But there are sort of like general rules to being a good investor and trader. And, when you're in speculative positions, you should probably be thinking about the downside protection. Otherwise, you risk losing all your money. So, yeah, there's lessons to learn. I think everything's going to be different. To the point you just made, though, I think this is a really good for folks to hear. After the S hit the fan in 08, there is always this period of restabilizing, or like a neutral sort of like flat period. And then it starts to go, and then it accelerates because more people want to jump in, then their friends jump in, their friends of friends jump in, et cetera, et cetera. So, like, the end of a bull run, oftentimes you can look at it on a chart and be like, wow, I see. Like, everyone was in it. This happened with the carry trade back in, oh gosh, I forget the year. I'm going to totally draw a blank now. This happened in the carry trade. This happened with long-term capital management. This happens with Bitcoin in 2017. This has happened with real estate in 08. It happened with tech stocks in 01. I mean, it's just the same pattern repeats. But if you don't know what the pattern looks like, and you don't understand how they build, it's going to be very hard to find it. So after 08, it took a bunch of years of being really slowly trying to get back on an uptick to blasting off, right? I would imagine, with high interest rates and a lot of money getting blown up and a lot of accounts getting blown up in this current market, it's going to be the same thing. It's going to be a slow and steady build. So there's no need to rush in. There's no need to like desperately try to find a deal. Excuse me. There's no need to desperately find a deal. I think that if we take our time, we take a breather, and we look at what's happening in the market overall, there's going to be opportunities. They're going to be there for a long time. And I think it offers a very unique chance to get very creative in the way we do things as well. I'm hearing more and more conversations now than ever about seller financing in real estate, because at these kinds of yields, if I'll give you an example. If I've got a property I was considering selling, I'm not going to sell it now, but I was considering it. And if someone said, look, I want to buy your property, I have 10% to put down, can you cover 10% mortgage? I'd say, sure. If you can give me an 8.5% yield, I'm more than happy to take that. So you don't have to put 20% down. Right? Because at that kind of a yield, that risk to me is worth it. I don't mind doing that deal. But at 3.5%, that's not worth my time. So higher rates, although feel like they're terrible and going to affect everything, it also offers some unique opportunities as well. Right? On a bond yield, I'm only going to get 7% short term. But if I can do a 10-year balloon seller financing deal on a property and have a second lien position and protect myself because it's backed by real estate, for me as an investor, I'll take an 8% yield for 10 years guaranteed by real estate. I think more and more people are like me, and they're going to look for those kinds of yields and get very creative in how they structure and sell their properties. Because now, for me, I may not be able to get, I'm going to use like just super basic numbers. Maybe I wanted to sell it for 100, but now I can sell it for 90 or 80. Well, maybe I sell it for 80. I pay less capital gains taxes on it.
Yeah.
And I get to collect 8% yield for 10 years. That sort of makes up for it anyways. So I still have that. I still have the yield. I still have the gain. I can 1031 my money. I mean, there's so many strategies. I hate to get so specific in terminology. My simple point is, I'm not approaching situations like this from like, hey, which stock should I pick? I'm literally taking the opportunity to say, globally, which markets have the best opportunities within which asset classes. Maybe it's real estate on the coasts because the prices have come down. Maybe it's yield in the Midwest because prices have come down on real estate. For stocks, hey, maybe this is the time to get back into core tech holdings. Or conversely, maybe for some people, it's the time to get that better yield or fixed yield on a good dividend player or a REIT. I don't know, right? And maybe you want to buy in Australia versus buying in Canada. Maybe you want to go and look at a currency rate differential that you think is going to be very favorable on the US dollar versus the euro. I don't know. But the more you can think about in terms of just learning what they mean and how they interact, the better life is going to be.
I think you answered my original question about NFTs and cryptos. Are they going to go crazy again in the next bull run? Maybe, because we've seen it from 08 to 01. Everyone hops on the train as it comes, and then it crashes and keeps repeating itself.
Well, just on that note, and then I actually am interested to hear your take on Palantir instead of me doing all the talking on this news. But on the NFT thing and on the crypto thing, I got a ton of flack the other day, as usual, every time I post anything about crypto. And I was saying, look, you have to bifurcate the market. There's speculators and there's actual builders with the technology. Speculators, it's done. In my opinion, it's over. Like, you've all been screwed. It's bankruptcies, it's scams, it's frauds, it's over. Okay. Those are coins. That's a pile of bullcrap. On the other side of it, I think there is promising technology. We have to figure out what is the most promising technology in that space. And that can be the baseline of how we build that into what's already existing today. The same goes for NFTs. I'm trying to choose how much I want to say here. I work with a lot of professional sports teams. And I can tell you in that space, the idea of NFTs is very significantly valuable. I don't mean like a picture that gets saved on your computer and it's yours, but like having a fun way to like track the games you go to and get access behind the scenes, like a VIP kind of card. Am I a believer in NFTs? Truthfully, not really. Can my opinion be changed? 100% in a heartbeat, it can be changed. If you can show me data or an opportunity or a way that you're thinking about it that I'm not understanding, I am extremely flexible into changing my mind on something that I maybe don't understand. But as I understand it today, buying, yacht club monkeys or whatever the hell they're called, right? Like, I could care less. I could care less about some stupid picture that might be worth something or not. And I think the reason for that is because I'm ahead of what most people who are watching this probably are. But I can tell you, I didn't get here because I bought speculative crap. I was buying low price real estate after crashes. And I was getting into equities after they went down, but shouldn't have because the entire market went down, right? Like, I bought Citibank at 99 cents after when 08 happened. Okay. Like, that's how you generate wealth. When I'm buying single families for 50K, that's how you generate wealth. I wasn't buying I can't even think in 08 of something that could even be equivalent to this, I guess. I wasn't trying to buy 12 times leveraged mortgage-backed security CDSs with swaps, right? Blah, 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 blah.
It had a picture of a monkey on them.
With a picture of a monkey on them, yeah. So let's deviate for just a second. I know we're late and we've been going for a long time. I saw the news about IL-6 with Palantir and the new level of access to secure data. They're one of only 3 companies now that have reached that level. So I believe that's what AWS, Microsoft, and now Palantir are the only 3 companies on Earth that have achieved that level of security clearance. Yes?
Yeah.
What's your take on that?
So I did one tweet on this that ended up resonating with some people. 2 of those companies are worth trillions. One of those is worth 15 billion. Now that obviously the 2 companies that are worth trillions have massive consumer products, and there's it's not a black and white comparison, but it says something that one company that's a measly tiny company by market cap, given the macro has been destroyed, is getting into the door with the DoD at a level 6 certification that 2 massive giants are, especially in the cloud computing space, because Palantir is not really selling compute to them. They're selling this new integrated way for them to use AI, ML ops to be able to actually secure really classified data. I think it's exciting. I think it's interesting. This is on the back of $800 million of deals that came in September. I mean, Sham now looks like a genius in February at the Morgan Stanley conference, where he was like, well, the government's going to have to spend it. It's probably going to get spent really soon in a really compressed amount of time. They have $780 billion. It's got to go somewhere. We think we're going to be the ones to capitalize on a decent amount of that. And it seems like they are. So, I mean, I'm bullish on it. It's great. It's not going to make the stock price go better. But as a long-term investor, I'm looking at this like, for $8, this is not too bad.
It's sort of like if you take, I like to do this thing all the time where I forget about the price, forget about the stock, forget about the market cap, forget about it being a publicly traded company. Let's just for a second pretend it's not publicly traded. You can't buy shares even if you wanted to. Okay. Would you be interested in a company that's one of only 3 to achieve the highest level of classified data access on Earth? Of course, any investor is going to be like, yes, that's absolutely incredible to think that only 3 companies have ever gotten there, and one of them is not like the other 2.
Yeah.
And if you extract the emotion and the controversy and the outgoing eccentric CEO and maybe its founders for a second, you just focus core principle of technology, executing on the technology and the mission, and executing on getting contracts done. It is absolutely mind-bending to me that they have achieved in IL6. This is the kind of thing that's not going to talk about hoopla, using hoopla at the wrong time. This won't get a lot of hoopla.
Yeah.
Because people don't care. People who like it already like it. People who don't.
Yep.
I want to present a different thing to you. How bad would it be if AWS lost IL6?
Right.
People would go bananas because they'd recognize what an unbelievable, unique opportunity is to have that level of access. And I think that in a bit of irony, folks don't see it in the reverse of what this could potentially be. And I'm not like an ultra bull. I mean, I'm bullish, but like, you know what I'm saying? I'm not singing the praises 7 days a week, twice on Sunday, but you just can't step away from this and say like, come on, it's because so-and-so knows so-and-so. Like these are the kinds of things where there can be no error. You cannot have problems with any part of your solution and have things like this take place. So
have you been bullish on the recent $800 million in deals that you've seen?
I mean, to me, I don't mean to be funny when I say this, but like it sort of just goes without saying. I don't even need to make a comment on it. I don't think, right? Like It's absurd. It's absurd to think that almost $1 billion in new contracts, IL6 certification, one of only 3 vendors on the planet Earth who are allowed to have that. I mean, I don't know. Does a market cap of 15 billion justify doing $1 billion in a month while sitting on what, 2.4 billion still in cash, give or take, and another billion or so in credit facilities? I don't know. More and more, even if you despise everything about them, what they do and everything, and you're super emotional and you don't want to look into the details, fine. I get it. Some people are going to just hate it no matter what. There's people who hate AWS no matter what. There's people who hate Microsoft no matter what. There's people who hate every company in the world no matter what, because they're not socialist or communist or Democrat or Republican or whatever. And someone's going to hate it no matter what, because it's something that they don't like. If we extract the bullshit, we look only at technology. That's it. Extract everything else from this conversation. I don't want to know the name of the company. I don't want to know who founded. I don't care who's running it. If you are closing contracts in the hundreds of millions of dollars on a regular basis, and your technology is proven to not only work, but be uniquely certified in a place where you have no competition now, because they don't. Let's be fair. That is something to, at a minimum, be excited enough to warrant additional research on this topic. That is my full stop feeling right now. I am not recommending it. I am not saying you should buy it. I'm not saying you have to buy it. I'm not saying you shouldn't buy it. What I'm saying is there's clearly a reason why there are only 3 companies currently on Earth that have achieved this level of clearance and executing on this amount of contracts, yet has a market cap that's not reflective of it whatsoever. If nothing else, it deserves more research. And I don't mean by YouTubers. I don't mean by people on Twitter. I mean, real analysts at major firms are going to have to start paying attention.
Yeah.
They don't have a choice now. Because what's going to happen is speculation, not financial advice, right? Like they're going to start to look at these things and someone's going to come out and say, we got this wrong. Here's where this probably should be in the next year or two. And then everyone else who wasn't on it is now going to have to kick off coverage or initiate coverage on it. So once those coverages are initiated, they're going to have to start digging in. And whether you hate them, you despise them, you don't like anything about them or anyone who created, founded, or runs it, you cannot ignore the math and the technology, because at the end of the day, it's just math and technology, right? Finance being math. So that's where I stand on it. I haven't even, I'm sure you don't really notice, but like I have not commented on them at all. And I'm going to tell you why. It's because I don't think anything needs to be said. I think that this was an opportunity to say, the proof is in the pudding, and they've delivered tons and tons of pudding. And it turned out it was a full course meal. It wasn't just dessert. So that's my take on it. I mean, when we first started talking about this, you and I, when we did our very first pod together, which feels like 20 years ago, but it actually wasn't.
Right.
And we were talking about why we were excited. We weren't talking about the CEO. We weren't talking about Peter Thiel. We weren't talking about politics. We weren't talking about any silly emotional.
We're talking about how data is operationalized for cancer research.
Yep. We're talking about massive amounts of data that require massive power to understand the data, execute on the data, and take action on the data in the workflow where it lives. Since then, that has happened. One thing I never comment on is the price, because I don't care about the price. The price matters to me long term, but I don't care about the price today. I don't care about the price in 12 months. I don't care about the price in 24 months. I care fundamentally, is this a company that I personally, not financial advice, would want in my portfolio because it has the right aspects of a long-term company that can be acquired, do some acquisition, continue to grow, continue to execute, and raise its market cap? The answer is yes, for me, based on my portfolio, my style investing. And I'm not being cautious because I'm worried about saying the wrong thing. I'm being cautious because I still think people don't actually understand what's happening here. Even people who I would say are pretty smart and know technology, they're not behind the scenes the same way. More and more people that I speak to are really shifting gears into what the world is becoming. And they're recognizing the fact that a data science team cannot keep up with the jobs at hand, right? They need to operationalize as much data as possible. They need as much process automation as possible. They need visibility in the workflow within the hierarchy of how they go to business that's automated, delivered, and executed in real time. There are just not a lot of people who can do it to that effect. There are some, there aren't a lot. And I think that speaks to sort of the level of strength in the market. And this is a total aside, so separate from just talking about the Palantir piece. If you go and look at not just IL6, but sort of anyone who's approved within that sort of FedRAMP, there's no bad companies in there. I mean, there's some that are better than others. But like, if you're a brand new investor and you're trying to figure out like, hey, what tech company should I pay attention to? That's not a bad place to just start learning, looking at like who has achieved FedRAMP, who's working with governments. It doesn't mean you should invest in them. I don't know if you should or not, but it's certainly a good place to start thinking about the stringent details it takes to get on those contracts and be an approved vendor. It is not that simple. You and I can't start a company tomorrow and get on FedRAMP. It just isn't. It doesn't work that way. You just can't. So I would just leave it at that if nothing else, from a person who is passionate about machine learning and data science and AI and data and technology. These are exciting things, full stop, on their own, irrespective of an impact on price or market cap or the company.
Okay. That's where we ended. Good stuff. Got a lot of lessons in here. Hope everybody enjoyed. Lots of stuff on the macro, lots of stuff on Palantir, and lots of stuff on GameStop, which is always.
Well, you nailed it. I did a lot of talking tonight. I didn't even mean to.
No, it was good. I forgot Roy and Kitty was a person, so I looked him up. I was like, oh yeah, this guy did do those. I was like, wow.
You know what? Let's end on this. Really good call out. The only person that received any punishment was him.
He received punishment?
He lost his. They took his broker's license away.
He probably sold all of his GameStop though, so he made like 30 million bucks or something.
How much money?
Why else would you stop streaming, right? He's like, oh, I'm gonna stop streaming. It's like you sold, you're out, like you're good.
Yeah, but I mean, even my point though was like they basically showed how like Robinhood essentially lied.
Yeah.
Even though they couldn't necessarily prove it, they did show that how there was actual conversations happening, and
yep.
Clearly it's like but a horse of a different color, I guess, to be expected. Like you said, he made 30 million. Hopefully he's doing good now. We'll see.
Yeah. All right, everybody. Thanks so much for listening, watching. We'll see you next week on Not Financial Advice.
Yeah.